Aloha, I'm Carl Bonham, Executive Director at UHERO, and I'm coming to you with this UHERO Focus video to talk about our first quarter 2023 forecast report. You know, it's a little bit more optimistic than our last two reports. The U.S. economy continues to be more resilient and a stronger labor market, sort of modest consumer spending than we had anticipated, and that is translating into really stronger U.S. visitor demand than we were expecting at this time in the fourth quarter or even in the third quarter. We continue to forecast that the U.S. economy will experience a mild recession in 2023, maybe slipping into 2024, and Hawaii will avoid that. So Hawaii will avoid that recession. That's kind of a key takeaway. You know, the story for 2023 is still going to be high inflation. The Fed has been pushing up interest rates. This is the Fed funds rate. This is the interest rate that the Federal Reserve controls. And in their last 8 meetings, the Federal Open Market Committee has raised its interest rate at every time. They're meeting in 3 weeks. They're going to raise it again. So the target for the Federal Reserve is going to be at 5% by the end of March. The bond market has sort of finally come around to the Fed's mantra, which is higher for longer. And the gold line here is showing what the bond market expects the Fed funds rate target to be for the rest of this year. So they're thinking we're going to get up to 5.5 percentage points, and we're going to stay there. Now, the bond market has been too optimistic for all of the last year. So if they get it wrong and rates are even higher, that's another story. But so that's the backdrop. And what's the purpose of raising those interest rates? Well, the Fed is trying to get people to stop borrowing money. They're trying to reduce demand for loans, reduce borrowing, and that means reduce spending, which then means reduce demand for workers, which means reduce pressure on wages, and then ultimately reduce pressure on inflation. That's the goal. And so the question is, inflation has come down from 9% in summer of 2022 to 6.4% nationally with the latest data. And the question is, does that continue? Our forecast is U.S. inflation around 3.5% by the end of the year. And that should be enough for the Fed not to keep jacking up interest rates. So those interest rates are biting, and the place they're biting is in housing, nationally and in Hawaii. This graph is showing resales of single-family homes on each island, and you can see the very, very sharp drop. This is Oahu single-family resales. So we're talking 46% drop year over year. That's consistent what we're seeing at the national level, but that's the biggest drop we've seen since 1991 on Oahu. And we're seeing resales getting down at a level that's consistent with Great Recession levels. Right, so the bottom of the Great Recession, these are resales after 2008, 2009, we're getting there. Now the good news is that means that home prices are starting to come down, and rent growth has also slowed very, very sharply. And so that's helpful with the inflation picture. And if you look at the inflation picture for Hawaii, inflation in Hawaii has come down very, very sharply. And this chart is showing, the orange bars are showing inflation in the Honolulu CPI for the last 12 months to January. The last data point we have is January 2023. And so that full year, that annual inflation rate of 5.2% is compared to just the last 6 months. If you annualize the last 6 months of inflation, that was only 1%. So that gives you an idea of how fast inflation has come down. That means that the prior 6 months was 9.5% for Hawaii. The reason for inflation coming down so fast in Hawaii is these components that some of them transitory, energy, for example, but also rents. The shelter component of the CPI, which includes rents plus utilities, is the largest component, and it's gone from positive to negative. We've seen positive to negative switches for new and used cars, for gasoline, and we're going to see that for food at home. Food at home has really just completely flattened out over the last 6 months. So that's good news, right? So if you're getting any kind of wage increase, that means those wage increases you're actually making progress against rising prices. And as we see Hawaii's economy slow, we think that progress on inflation is going to continue. We think by the end of 2023, the Honolulu CPI will be growing at less than 3% annualized. And so if you take that slowing into account, we also think that the labor market is going to be normalizing. And excess demand for workers, not being able to find workers to fill jobs has been a story ever since the pandemic. The labor market in Hawaii has already normalized. We're just sort of still looking backwards and not realizing how fast things changed during 2022. This is a measure of excess demand for labor. So this is the statewide total demand for labor minus labor supply. It peaked at 40,000 workers at the end of 2021 and has fallen dramatically down to 13,000 at the end of 2022. That's lower than it was back in 2019 and in 2018. So the labor market has already normalized, mostly because job openings have diminished, but also because the labor supply grew very, very quickly during 2022. So those declining job openings is really what we expect in 2023. So the slowing of the Hawaii economy associated with much weaker tourism and overall effects of higher interest rates and higher inflation mean a pause in hiring. So you don't exactly see the pause, but from 2022, our growth rate in payroll jobs was 5.5%. 2023, it's 2%, and then even weaker in 2024 as the follow-on effects of that slowing Hawaii economy show up. So we're not talking about layoffs, we're talking about fewer job openings. So businesses demanding or looking to hire fewer workers because their business is slowing down. That's sort of the optimistic outlook, is that we don't see big losses of jobs. We don't see a big increase in unemployment from the 3.7 we are at right now. We get up to around 4, maybe a little bit higher than that. So overall, this is a pretty optimistic forecast. We expect the US economy to go into a mild recession. We expect Hawaii's economy to avoid that. And there's some risks. If inflation doesn't come down enough, the Fed keeps pushing up interest rates. And of course, in our next report, we're going to have to be talking about the debt ceiling debate that's coming down the road. Aloha.